Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review for the week ending July 23rd, 2021. But most importantly, our chief economist, Clément Gignac, is back with us today. So, good morning, Mr. Gignac.
Hey, good morning. So after 3 weeks, I have to work at some time. So I'm back. So happy to see you again.
Yeah, happy to see you too. I will be covering the markets first, but I'll let you brief us on what happened on the economic landscape, and then I'll be back to dig a bit more into the markets. But first, the markets on Monday, we did have a few emails from clients and from advisors about what was going on, but buy the dip mentality came back on Tuesday, and when you look at the picture week to date, well, positive for North America on equities, up to 1.8% for the Nasdaq. Still a bit negative for EFI and emerging markets, but as we are recording this on Friday morning, markets are open with some green on the screen, so we'll see where we end up. And Canadian bonds positive on the week again. Interest rates keep on crawling lower, so 0.2% for the long index, but year to date still negative territory. Other markets, the price of oil was also very volatile on the week, but still up after 4 days. Canadian dollar followed suit, and euro and gold were down on the week. So now to discuss COVID and the economic landscape, I hand it over to you, Clement.
Yeah, thank you. So, as usual, we start with the COVID situation. It's amazing that we continue to update after, let's say, 15, 16 months, the situation. And unfortunately, it seems that with this new variant, they have some countries who have difficulty to deal with. Notice what happened in UK. It's not, it's close to the record high that we have seen a year ago. All of this comparison, of course, is daily new cases. It's a moving average 7 days, but it's expressed per million population because country have different population, as you know. Notice what happened, even Eurozone, notice US. Interestingly, is Canada. Canada, we seem so far to not to be too much affected by this new variant. Part of the different reason, but part of the explanation, maybe, okay, it's probably associated to the fact that the vaccination campaign were experiment a slow start, to say the least. But notice now we are number two with 70% of population have already received one doses, and more around 50% of the overall population are fully vaccinated. So it's encouraging what we see, but make no mistake, no complacency. This is a situation that we have to continue to monitor. So hoping that things will improve, but clearly it's not precise science. We have no roadmap regarding that. It's a situation that we have to monitor. Talking about next slide, we talk about business cycle. For some people, it could be perceived as an old story, but guess what? It was officially this week that the National Bureau of Economic Research, who's the official organization who determine the dates of the business cycle, has officially mentioned that this COVID recession has lasted only 2 months. Was surprising, but the definition of recession for economists, as you know, is when we have a contraction of the GDP. So yes, the GDP has contract, as you can notice on the right side, on the second chart on the right, by 23%, what was a record contraction of GDP. But it lasts only 2 months. Usually a recession lasts between 7 months to 15 months. But this is very interesting. But I thought that was a word to share with you that this is the shorter recession followed by the more significant, impressive recovery. Interesting stuff that have been confirmed by National Bureau of Economic Research this week. Next slide, talking about U.S. inflation expectation. The jury is still out to say if it would be temporary or more permanent, but clearly, in fact, the optimism camp has been pretty happy to see that they have some relief until on the inflation expectation. Is it really peak? We don't know yet. The core inflation, you can assist with the dotted red curve, is still accelerating. But if you go with the bond market and you have the break-even inflation, the break-even inflation in the bond market suggests that you have some deceleration. All of that could be influenced by commodity prices. On the right side, you have two curves again. The dotted red curve is the same than the previous one, is the core inflation. But the blue curve this time is commodity prices. Notice that you have a rollover, so a deceleration. So we will see. But this is some good news development. We will see central banks continue to be optimistic about the fact that we will avoid a permanent inflation acceleration. But as mentioned, we have to remain cautious. No complacency because it's not clear yet with what's going on about the global supply chain, what happened to inflation. Next slide, we talk about, in fact, Canada, the labor market recovery. Labor market recovery have been impressive so far. 85% of job losses during the COVID has been recovered. We're still short of 340,000 jobs to be back to the pre-COVID level. But since the trend has been uptrend for last few years, in fact, it's probably miss 1 million job before we return to the what we could call full employment on the job market. So we will see, but we found interesting that at least we already recovered 85% of job losses during this COVID-led recession. Next slide, we talk about real estate. Real estate home price have accelerated to a record level. We talked about 16% year over year, but the transaction, the volume start to decelerate. This is 3 months in a row that we have a deceleration of the in terms of volume. So is it a leading indicator that we will have some deceleration, softening on the real estate? We will see. It could be interesting. This morning, because we register on the Friday morning, we have the retail sales breaking news as just released. So it's better than expected. The expectation was minus 3.5 for May. Retail sales in Canada, it's minus 2. But most important, Sébastien, is the flash estimate for next month, for June. With the reopening of the economy, it's indicate that we could have a plus 4%. So it will be very encouraging so on Canadian economy. And finally, on Canada, let's talk about the Canadian dollar before Sébastien kick in on the financial market. Notice we have, from time to time, we present that slide. This is an internal model that Sébastien and the team have developed, and you can notice the red curve is the fair value of the Canadian dollar, I will say, and the blue curve is the current value Canadian dollar. Notice the gap. It's unprecedented in the last 10 years to have 11% undervalue. This valuation on the Canadian dollar, the factors to explain that is inflation expectation, Canada, US, real interest rate, Canada, US, the oil price, other commodity prices, and the credit spread as an indicator of a risk on, risk off market, if you want. But clearly, this Canadian dollar is undervalued. That's part of the explanation why Sébastien and myself in the funds we manage together for many years now, we hedge partly our exposure to the US stocks. We think that this Canadian dollar is undervalued. Not only our model suggests that, but even the fundamentals on Canada, from my point of view, are much better than US. Just think about, for example, public finance. We are much less debt on the public finance in Canada than US. It's 50% GDP in Canada, federal debt compared to close to 100 in US. So we will see, but I'm a long-term bull on the Canadian dollar. So I was a little bit long, Sébastien, but a lot of things as have been seen during my holidays and possibly in beginning of this week on Monday, it was very volatile. So curious to have your explanation what happened on the market and catch up on your expertise on the market.
Sure. Thank you. Thank you. Yes, we did have Quite some moves early this week. So for everyone out there, I mean, on Monday morning we had a pullback in the stock market that even accelerated through the day, and then after that on Tuesday morning, well, it was more of a buy the dips mentality, and as I showed earlier, we're actually up on the week. So on the left here, you have the Fear and Greed Index. This is from CNN Money, and it's an index that they put together. And now it's showing what they call extreme fear. But I mean, when you look at the definition of the index, it's all about the fundamentals, like the breadth of the market, the positioning in options. So everything that has to link with our people protecting against the downside now, or are they seeking more upside? And it seems now that we are protecting more on the downside. So 1 week ago it was fear, 1 month ago it was fear too. So we're kind of in an environment that is more fragile because the breadth of the market and the positioning leads to potential spouts of spikes of value, volatility like we've had on Monday. But will buying the dip be the norm? Who knows? But it's going to be the return of volatility is normal. So here, the chart here from Strategas shows that at the sector level, opportunities are taking shape. So there's always a positive in the markets. There are so many opportunities out there. But if we go through the chart first, on the top is the S&P 500. As you can see, it's going higher and higher and higher with not much volatility. And the blue line is the 50-day moving average. So we're not technicians here, but 50-day moving average. The red line is the 200-day moving average. As you can see, the market is kind of hugging the 50-day moving average and bouncing off of it. So the market seems to be stubbornly going up. But when you look at the line on the bottom, it is the percentage of stocks that are trading above their 50-day moving average. So that's the breadth of the market, and it's declining. So what we have right now is we have a market that is supported by less and less names. Usually you want to have both lines elevated. So you want a market that goes up, and most of the stocks on the index going up, or at least being above their 50-day moving average. But we're seeing a deterioration of the fundamentals. So there's less and less sectors holding the index together. So now the box here on the chart that tells us that a few sectors have already underwent correction, and there are some nice opportunities there. So energy, materials, and financials. So mostly cyclicals, mostly value stocks have corrected already. So we're starting to buy some of these and to sell the exposure to the index in the same way, just to make sure that we don't add to the stock exposure of the portfolios, but start to add the exposure that we want through some ETFs, through some futures. So there are some good opportunities out there that we're already starting to take advantage of. Also looking forward, small caps are not a place where recently we started to make some tactical moves, but right now we do see on the left that the valuation of US small caps versus large caps is as cheap as it's been since 2008. So the small caps are very cheap compared to large cap. And on the right you see the blue sticks are the Russell 2000 earnings expectations. Russell 2000, this is the US small cap index, so very high compared to the red sticks, which is the Russell 1000, so the large cap index. So that means that on the right, there are the market estimates that there are better expectations for earnings within small cap than large cap. And on the left, you have also that small caps are cheaper than large cap. So if you put the two together, you have a very good foundation here for long-term outperformance from small caps versus large cap. So those are the kind of trade ideas that we are looking at right now. So within the volatility, within everything that happens, there are always some pockets of opportunities out there that are ripe for opportunists. Interest rates, before we go to the news of next week, the 10-year rate in the US, as you can see, still moving lower. So on the left, the chart is the 10-year treasury yield compared to the copper to gold ratio. We've shown you that chart before, and we like the copper to gold ratio because copper is a metal that reacts well has a strong relationship with the economic cycle and risk appetite. So when economy is good, risk appetite is good, copper tends to go high. And the price of gold is more of a protective metal. So when there's some stress in the market, gold rises. So the copper to gold ratio is a good gauge of risk appetite or economic prospects gauge. So it's a good indicator. As you can see now, there's a big divergence between the two. So interest rates are lower. We do hear of other asset allocators like us, and we have also done that in the portfolios who buy some bonds to hedge their stocks exposures. So this is a good way to balance a portfolio, but also the uncertainty with the variant and maybe peak economic growth that I've mentioned the last few weeks, it's also weighing on interest rates. So in the short term, move seems to be lower, but in the long term, the chart on the right, this is an analysis from the firm BCA. They have their own pipeline inflation indicator, and as you can see, it's as high as it's been since 2010, and it's clearly pointing towards higher interest rates. So in the short term, who knows? The trend seems to be lower, but in the long term, we do think that interest rates will eventually rise to levels way above the ones that we have here. So what to watch next week in Canada? Inflation last month we had 3.6% in May. We should have higher than that in June. GDP growth for June should be positive. The flash estimate for retail sales for June was plus 4%, as Mr. Gignac mentioned. So GDP growth should be good. In the US, we'll have the decision of the Fed, the FOMC committee decision. We'll have GDP growth for Q2 should be at 8%, and personal income and personal spending should also be interesting to watch. So that wraps it up for the week. So ia.ca/economy, again, it's your go-to webpage. If you haven't done so, you can subscribe to our newsletter. So I'm heading off for at least 2 weeks of vacation, which I think were well deserved. We'll be recharging the batteries, and I hand it over to no one less than our chief economist. So I'm sure you will be covering everything while I'm not there.
Yeah, you create expectations. So I will do my best, Sebastien, and you deserve good holidays and hoping that you will have a lot of sun. So
All right, so thank you. So I'm leaving. I'm leaving. I'm happy to go to vacation, and I'm sure we won't miss a beat. I mean, having you there, our clients are in very good hands. So thanks everyone, and we'll be back again next week with another edition of the Weekly Economic Review.